Ever wondered whether it's better to invest your money in the US or in India? Well, that's exactly what I'm going to be talking about today. I'll tell you all of the different factors you have to consider, as well as what the best strategy is, which makes the most sense. So let's get into this. Hey everyone, welcome back to the channel. Today's video is about another hotly requested subscriber topic, and that's, as somebody in the US, does it make more sense to invest here or invest in your home country? I'm mainly going to be focusing on India in this video, but a lot of what I'm going to be speaking on applies to other countries as well. So if you're looking to invest in China or other countries in Europe or even Africa or whatever it may be, a lot of these topics still apply and you need to keep them in mind. They also apply across different investment avenues. So this would be things like stocks, bonds, real estate, mutual funds, fixed deposits, and others. All right, so the first thing to consider is the currency rate difference. Obviously, in India, the currency is the rupee, and in the US, it's the dollar. And if we look at the last 10-20 years or so, the Indian rupee has witnessed a consistent decline versus the dollar. This is a pretty big important factor because any investments you make in India are obviously going to be in rupees, which means that it declines in value over time versus the dollar. For example, back in 2011, $1 was worth 45 rupees. But then 10 years later, now in 2021, that same dollar is worth 72 rupees. If I took $10,000, invested it in India by converting it into rupees, and it grew, let's say, 50% in this time frame, it would still be worth less than leaving that $10,000 just sitting in your bank account in the US. And if you invested that money in the US, that difference would be even greater. So there will always be a currency risk when you're investing between two countries because these currency conversion rates keep changing. The second thing to consider is inflation, which just refers to the natural increase in price of goods over time. And when you look at the US, inflation rates have hovered around 2%, but when you look at India, the inflation rates are at around 5%. But how does that factor into this discussion? It just means that we shouldn't look at returns based solely on face value. So for example, if we look at bank accounts in India, the interest rate is around 5.5%, but in the US, bank accounts give you only 0.5%. If you look just at absolute numbers, you might be thinking to yourself, okay, it's a no-brainer to keep all of my money in India because the interest rates are higher. But in reality, when you consider inflation as well, you realize that both of them are pretty much the same. The same holds for stock market returns as well. When you think about India and the Indian markets, it's generally known that the returns are in the 10 to 15% range on average. Whereas when you consider the US market, returns are more in the 6 to 8% range. But again, we should not be misled just solely by the absolute numbers. Digging a little deeper into this and comparing the Dow, which is the US index, versus the Sensex, which is the Indian index, we see that the Dow has outperformed the Sensex in 5 out of the last 10 years, with an annual growth of 10.87% versus the Sensex's 9.55%. This gap becomes even wider when you account for the rupee devaluation that happened over this time. And in addition to all of this, the volatility in the Indian market is also much higher than the US market. So it comes with added risk too. The next thing you want to consider is tapping that like button and subscribing to the channel for more content like this. Don't forget to also hit the bell notification while you're at it. No, but seriously, other factors include repatriation. Every time you convert USD to INR and then back again, it's not going to be free of cost. there will be a fee every time you do this conversion, and you never know what the conversion rates are at that time, so that's a risk too. The last thing I wanted to mention is that having international investments either in India or in other countries does make taxes a bit more complicated. If you are a tax resident of the US, you have to file what's called an F bar and pay taxes on all of your worldwide income. So just keep this in mind too. Alright, now coming to the most important part. Based on everything that I spoke about so far, does it make more sense to invest in the US or in India? To answer this, you first need to ask yourself, where do you see yourself in the long term? So in the next 10-20 years, do you see yourself staying in the US or do you see yourself moving to India? If you think you will be moving to India, then yes, I think it does make sense to invest a portion of your money in India, because this way you will start building up a nest egg, you'll have assets in your name, and once you do move over, you can just pretty much hit the ground running. However, if you think that you won't be moving to India in the long term, then you have to evaluate India like any other investment destination in the world. And in this case, I personally think that it's better to keep your investments in the US itself. The US stock market is well established. It has a long and consistent history. The dollar is the world's reserve currency, and it's just easier to manage all of your money in the country that you're living in. Moreover, a lot of the companies in the US are international companies. So when you look at the biggest companies in the S&P 500, a sizable chunk of their profits does come from abroad already. Companies like Apple, Amazon, Google all have operations all across the world. So just by investing in these companies, you are still getting international exposure. That being said, more diversification is not necessarily a bad idea. A well-balanced portfolio has investments across industries, across different asset classes, and importantly in this case, across geographies too. India is one of the fastest growing economies in the world, and it has more potential for growth than some of these more mature markets. And it is possible to take part in this from the US itself by investing in ETFs. For example, VWO is Vanguard's emerging market ETF, which invests in companies in China, India, Brazil, and South Africa, amongst others. It has high potential for growth, but that also means that it comes with higher risk. Some of its top holdings include Taiwan Semiconductor Manufacturing, Alibaba, Tencent, and Reliance Industries is in there as well. If you want to invest in an ETF that tracks solely the Indian market, then you can consider something like the iShares Indy ETF, which tracks the Nifty 50. So that would include the 50 largest companies in India like Reliance, HDFC, Infosys, ICICI, and others. Again, this is not investment advice, so please do your own research before investing. I personally keep all of my investments in the US itself. I just think it's a lot easier this way. I don't need to break my head with all of the complicated cross-country laws. Most of my money is just invested in broad-based index funds, so either tracking the total stock market or the S&P 500. I've gotten pretty good returns following this approach, so I'm just going to stick to this going forward too. My goal here on this channel is to share everything that I know about money and try my best to improve the financial literacy of all of the people watching. So I sure hope that you found some value in this video. Do let me know in the comment section down below what you think about this topic. I don't think that there is one single right answer because everybody's situation is going to be different. So maybe I missed out on some factors that you can let me know about, or if you just have any questions about this, I'd be happy to help too. Please share this video with your friends if you found it useful. It would really mean a lot to me. Also, if you want 2 free stocks, you can sign up with Webull using the link in the description box below. That's all I have for you all today. Thank you all so much for watching. I will see you in the next one. Bye bye.